90% of traders lose money because they don't know about smart money manipulation. In this video, I will reveal the 5-step process that big money uses to trap unprofitable retail traders time and time again. So here is the overall model that we're going to be depicting in this episode, and I'm going to break it down step by step. So let's go ahead and get into step number 1. Now, phase number 1 and what smart money love to create before they are going to make a very large move is going to be the range process. Now, most of you guys should already know what a range is, but pretty much range is when price gets caught between a high and a low and it's just moving sideways, right? Some of you might think of it as sideways price action. Essentially, you'll have some sort of swing high and some sort of swing low. And then what price will do is price will range in the middle of this and give you sideways price action. And lots of traders don't understand that this is actually done on purpose. You see, by doing this for an extended period of time, what they're doing is they're inducing the other side of each market into essentially forming an idea of what price is going to do. And so when you look at this, what I see as a smart money trader is I see a liquidation of a high and a liquidation of a low. So this is the model that we're going to be breaking down. And each part of this has its own unique phase. And so I'll walk you through phase 1 to 5. Let's get into phase 1. Phase 1 is known as the range. A range is simple. It's when price gets caught between a high and a low. Now, many traders look at a range and they think that nothing is actually taking place. But this is the first phase for a smart money manipulation. Because what price is actually doing when it's ranging is it's creating liquidity on both sides of the market. You see, there are millions of different traders looking to trade long and short for a million different reasons. And so when price ranges inside of a high and a low, there are many different traders who are looking all at the same piece of price action and formulating different ideas and different plans, right? So you have one side of the market who may be looking at these highs. So we had one high, we had another high. That is ultimately respect, and that creates liquidity, right? What does that look? How does that create liquidity? Well, essentially, you're looking at short traders who are looking at this area as an area of resistance. You see price taps in once, trades away, comes up again, trades away, comes up again, and trades away, right? So now they're looking at this area, that this is a key area. And so maybe there are traders who want to initiate sell orders in these regions. And where are they going to put their stop losses? They're going to put their stop losses in here, above this resistance level. That's one side of liquidity. What's the other side of liquidity that sits in this area? Well, you'll be looking at your breakout traders. You see, there are traders who are looking at this. Maybe they have some sort of pre-frame bias and they're waiting for some sort of price to come in here, break this high. And what will they do? Essentially, what they will do is they will initiate buy positions in these areas. And so they'll initiate those buy positions. And again, that is more buy-side liquidity that gets initiated into the market. And a lot of them will put their stop losses in probably places like this, right? A safe area where we have a low. And then if we look at the other side of the market, we have something very similar. We have the support traders who maybe have a pre-formed bias to go long, and they're looking at this area as a key level in which price has respected over and over again. And so you have a bunch of traders who would look to get long from this area, and they would put their liquidity, right, their orders and their stop losses at these levels. And then again, you have the same thing with breakout traders. There are lots of traders who would look at this and they're waiting for something to happen. There are so many breakout traders that see a range occur, and what they do is their whole strategy is wait for one side of the range to break and will enter with that break of that range. Well, what that does is it induces liquidity, right? It induces buys, sells, and stop losses. So what we want to do is we want to understand that characteristic. So why is it that smart money uses this range? Well, let's go into phase 2 and take a look at that. So phase 2 of this smart money manipulation model is the liquidation phase. You see, what price will do before it wants to go into its desired direction, let's say, for example, in this model, smart money wanted to take price higher, what they would first do is they would sell into an area of liquidity. So they would take out these lows, they would take out these internal lows, because what they want to do is if smart money are buying, they need to create a perceived supply of the said asset that they're trading. Why? Because they need that liquidity. Every buy transaction needs a sell transaction. And smart money, with a large amount of money that they have, they first need to manipulate price to go in whatever direction they want to go to. For example, smart money want to buy, right? But if they buy, they may not have enough sellers who are willing to take the other side of that position at the price that they want. Because again, they are moving billions and billions of dollars in transactions. So what do they have to do? They have to create the other side of the market. That is what the manipulation is. So if they want to buy, they are first going to create a fake area of supply. They're going to create inducement, right? The process in which they will get short traders to look interested in the market. So like we have in here, they will first push price into this level, right? And it will liquidate lows, and it will liquidate lows, and ultimately it will induce so much liquidity. We will have buyers who are getting stopped out of their position, right? Buyers at these levels of price who are putting their stop losses down here. Well, they're getting stopped out of their positions. And when a buyer gets a stop loss, that triggers sell side liquidity, right? So liquidity on the sell side. So if they can create that much liquidity, so much liquidity that they can use that to initiate their buy orders, they will get a better average of their price. So if they want to buy in here, they'll first create sells in here so they can match their orders with the sellers and get a better average of price. Now let's move on to phase 3. So here we are in phase 3, and phase 3 is the initiation phase. This is where smart money show you their real hand, the direction that they really want to trade in. You see, we've created this range, we've created sell side liquidity, buy side liquidity, and then we've had the liquidation, which was phase 2, right? And the purpose of that liquidation was to create the opposite side liquidity so they could get better averages in their orders. And again, smart money have more money than any participant in this market. So if they want to move price to a certain area, they need to create a perceived demand or supply on the other side. So that's what they do. And then what you will do is you will wait for an initiation. That is them initiating on their intention. And it will look like this. After we have this manipulation, right, the liquidation phase of price, you will have a market structure shift in the opposite direction. So we've just gone from something like this, put in a series of lower lows in, we've run into liquidity, and then you will see, then they will look at taking price higher. When this high breaks in here, that is your sign that smart money has just initiated their true potential, their true initiation. So where do we go from here? This takes us into phase 4. Phase 4 is the mitigation phase. This is essentially where their objective becomes mitigated. Once they've initiated price, they've shown their hand, you know the direction that they're going to trade in, price will come into phase 4, which is the mitigation phase. The mitigation phase is essentially returning back to the area that actually manipulated and then bought, right? So again, smart money in their manipulation, they are using their liquidity, right? Their capital to manipulate price. So they will sell into this level to capture all of the liquidity to create so much supply, and then they will buy that supply with all of their demand. Once they do that, what they now need to do is 2 things. Number 1, they need to cut the losses from the short positions. You see, when they put these positions in here, these are all short positions. So for a short period of time, they'll be running in drawdown. These positions will be in a loss the higher that price trades. So what they need to do, before they take price to where they want to take price to, they need to bring price back so they can close these orders at a better average, right? Sometimes it's a break even, sometimes it may be a small loss, but that loss is nothing in compared to the amount of money they'll make in the process. It's just risk management. And the second phase is that ultimately smart money, if they want to really initiate a position, a long-term position, what they need is a large amount of orders, and they can't fill all of those orders in one. So what they will do is after pushing price, they will leave resting orders in this price leg. So when price comes back, as it naturally will, as sellers will enter back into the market, price will return back to the area in which they can do 2 things. Close their losses from their sell positions and essentially put their other orders back into the market to continue moving price. So now they've got 2 sets of their orders in. And this is a process that they will do continuously until eventually they have completed their objective. And so if we come back full circle for a second, phase 1 is where we identify the range. Phase 2 is we wait for the liquidation. Phase 3 is we wait for the initiation. And phase 4 is where you are going to get into the market, which is right in here. And then phase 5 is going to be the continuation. Again, this is where price will continue. And so what we want to do is we want to identify phase 1 through 3, and we want to get involved in phase 4 and out in phase 5. Let's go and take a look at what this looks like in the actual live markets. Okay, so here we are on Euro USD, just about to open up for the London session, right? And first of all, what you can see is this blue box right here. This is going to represent Asia, right? And again, for many of you guys who know, Asia is a large pool of liquidity. It acts as the phase of the range, right? So we mapped out the high, we've mapped out the low. That is ultimately our range. Now, what we want to do is we want to wait for a clear sign of manipulation or inducement. So if we play price out, what you'll see is that price actually, before going right into this level, there is actually an aggressive buy out of this level. Now, why do they do that? They create this to what? Create inducement, so that when price comes into here, there is again more available liquidity at these levels. Because now what we have is a bunch of stop losses and more orders below this low. And that is what they need. They need that liquidity that sits under here so that they can trigger their real move into their desired direction. The thing is that there are a lot of traders in these levels. You may be one of them yourself. You may be that trader who tries to buy this area of support. You may be the trader who tries to sell on the breakout. You may be the trader who tries to sell on the breakout and the retest level, right? So all of these different interaction levels have a bunch of different liquidity sat in them, but nothing from the liquidity that smart money actually want to initiate, because they're trying to create the opposite side of the liquidity. So what we see is this as inducement. We have relatively equal lows down here. We have our range high to our range low. And then if we just play price out, you'll see that again, what happens? Price comes into the low, has this rejection from it, which tells what? This tells the buyers in this level that this price is a level that is worth respecting, because price comes into the level and has this reaction out of it. That in of itself may create more liquidity. And then we have a little bit of a push through that level. And then we have an aggressive push through that level with a reaction out of it. And so now if you look at this, you'll see that we had our range, right? We had the inducement to create more liquidity on the sell side. And now we've had our liquidation phase, right? Great. Now, if we wanted to get involved in some sort of order, we would need to see the initiation. And so what we would want to see is this high in here that actually liquidated the lows. We would want to see this get taken. Because if this level gets broken, that tells us that smart money has initiated their game plan. So if we play price out, you'll see that price has now broke through this level. That is going to give us essentially this market structure shift, right? This level in which price has very obviously put in a low, a high, a lower low, and higher high, right? All internal. From there, you can very clearly see that now they have initiated on their objective at higher prices. So what you can do is you can identify your order block. Your order block is essentially going to be this area in here, this sell to buy, so the sell level that liquidates price, and the buy momentum comes in all at once. Now, why is it this level? Think about it logically for a second. Smart money had to manipulate into here and initiate buys at the same time. So essentially they had to sell to buy, right? So when price comes back, they're going to want to bring it back to their level in which they had to sell into the liquidity that's sat down here. So they can close this at break even, and additionally, they can fill more orders from this level. And so what we would do is we would wait for price to return back to this level and then drop down to a lower time frame to get confirmation that this level is truly going to be held. So here we are now inside of this level. Now what we want to do is want to drop down to our 1 minute time frame so we can look at the fractal delivery of price and if we can see any sort of shift in trend. So if we look at things right now, you can see that price is obviously in a downtrend. We are in our point of interest. Now, we don't want to just buy from this level. What we want to do is we want to wait for confirmation on a 1 minute time frame so that we can get, number one, a better entry, but number two, confirmation that this is an actual area. Because the thing is if this area is protected like we think it is, then there should be orders that are about to be triggered. And if there are orders that are about to be triggered, then those orders should push price higher than some previous area of structure. So if we just identify everything for a second, you can see we have low, high, low, high, low, high, low, high, and low. You can very obviously see that the order flow is shifting to the downside. It's very obvious, right? As price approaches this level. Now, our confirmation is going to be a shift of this high right in here. So we'll wait and see what happens. So what you'll notice is price goes, puts in this low, a new low, price pulls back up and goes and puts in a new low once again. Now what we would need to see is a shift of this high. So once you get the shift of that high, now it is time to initiate your intention, because this has just confirmed to you that smart money have just stepped back in with their initiation. And so what we can do is the same thing again, right? We can identify this final area where price sold into this liquidity before the aggressive move out. You can see that this is a very aggressive candle, right? It has a lot of momentum in it. That is in of itself a telltale sign that smart money's orders have just been initiated back into the market. And so we want to use this area right here. We want to take our long position. I want to put our entry on the top and our stops just below the level. But you can see that this is such a small stop loss. I personally would not like to have such a small stop loss. So what I'll do is I'll add a little bit of spread on the buy side, and then I'll add a little bit of room to breathe on the sell side. That still gives a very, very nice size stop loss. And then where do we want to look at taking the position? If we understand that this is our phase 4, our phase 5 is the continuation. So we literally just want to target the next level of liquidity, which is going to be this external high in here. So we can just drag our take profit up to this level, and you can see right in the order flow, if we zoom out, how price has delivered itself. We had our range, we had our inducement. This right here is our manipulation, right? Smart money bring price back into these areas, are able to mitigate these levels in here. And then here is our confirmation that this level is actually accurate. And now it's time to go long. And we look at taking out the next draw on liquidity. So let's see how that plays out. So at this point, price is tagged in and broken the high. This is a very nice level to be able to go break even. So taking your stop loss from here and putting your stop loss into this level right here, just to make sure that if price does come back down for whatever reason, you weren't actually taking in any losses. And then we'd wait for price to hopefully deliver back up to the high, right? The next draw on liquidity. And that would essentially be your trade idea complete. So there you have it. There is the full take profit. If you want to learn more about these concepts and how to trade them, at the moment we have a crazy offer on. You can check the link down in the description.